Inheritance tax is often encountered in layers. On the surface, there's a headline rate that gets most of the attention. Beneath that sits a series of allowances added over time, shaped by past decisions and applied in specific order that can substantially change the final outcome for a family. Because those layers build quietly, they're easy to misread. People may know the nil rate band exists, but less clear on how it combines with the residence rate band, or how unused allowances can be carried across between spouses. When those layers aren't fully understood, families can find that small details, how a home is passed on, or whether allowances are claimed, have a much larger effect than expected. In this episode, we strip inheritance tax back to those core layers, and we look at how the main allowances actually work, why they're so often misunderstood, and how simple, real-world examples can clarify what families are really dealing with. To guide us, we're joined by Michelle Holgate, Director and Wealth Manager at RBC Wealth Management, who helps families peel back these layers in practice and explains the rules clearly, grounding them in live situations and helping people navigate complexity without feeling overwhelmed. Good afternoon, Michelle. Thank you very much for joining us. How does the nil rate band actually work, and what should families understand about its limits?
There's a few different elements to the nil rate band and inheritance tax allowances. So each person has £325,000 that on their death can be gifted away without inheritance tax due. Inheritance tax is due on anything over that at 40%. Now, there are ways that can be mitigated to a lower amount, but in the ballpark, that is what you're looking at. The nil rate band is also transferable between spouses. So if you don't use it on first death, you can carry that over to second death. And then there's also a residential nil rate band that can be considered.
Okay, so what are the key conditions determined whether a family can make use of the residential nil rate band?
The residential nil rate band is an additional £175,000 per person that can be used against your main residence. But there are criteria to that says it must be passed to your direct descendants. You also need the property value to be equal to or greater than the residential nil rate band. So if you're passing that property over and it's going to your children or your grandchildren and the value of the property exceeds £350,000, you've got £175,000 per spouse. On second death, that could be used. But there is a cap on what your assets can be. So your assets can't exceed £2 million without the residence nil rate band being impacted. So that would be impacted by £1 for every £2 that your estate is over the £2 million limit. And I think what's important to understand is some things do count towards the £2 million and some things don't. So it's always worth exploring that and understanding what is and isn't within that calculation. A good example being that business relief assets, which is investments into smaller UK companies, provided you meet the criteria of having held them for at least 2 years and then remaining qualifying at the point that you hold them on death, they sit outside of your estate for inheritance tax purposes, so you won't pay the 40% tax, but it does sit within these calculations for the £2 million limit.
So is that the full estate, meaning the property and any other assets like an investment portfolio that someone might have?
Absolutely, yes. So there are many different assets that people will hold. Some sit inside of your estate for inheritance tax purposes and some sit outside. So as we stand today, for example, a pension isn't inside your estate for inheritance tax purposes. So that's outside of these calculations, but pensions are coming into the estate from April 2027. And you've then got assets, for example, like business relief, where investments in smaller UK companies, if they've been held for 2 years under the point of death in qualifying assets, then they don't trigger inheritance tax, but they are still in the calculations for whether the residence nil rate band is deducted or not.
So where do you often see families missing out?
I think people miss out when they're not aware of these calculations. So in the example I gave above, if your estate had gone over the £2 million and you didn't realise the impact that was going to have, not only is the 40% tax due on the estate, but you've lost the £175,000 per person. The other thing we see a lot of people unaware of is pensions being subject to expression of wish rather than a will. So have they put that to the right individual to look to move that down generations, particularly whilst we're in a position of it sitting outside of the estate for inheritance tax purposes until April 2027. And you've then got the ability to pass on £3,000 to anybody each year, and that can be carried forward a year if it's not been utilised already. You've got gifts from regular income. That's becoming really, really popular now. So that is the ability to be able to pass on any surplus income that you have. So they'll look at all your income sources, all of your expenditure, and if there is a positive difference there on the income over expenditure, then you can give that away each year to your family, and it doesn't use any of your nil rate band for inheritance tax purposes. And it allows you to pass that on as long as it's habitual, is their rules. So it must be seen to regularly be done. I'll often encourage clients to fill in the inheritance tax form, the 403, to say that that's going to be the case.
Good advice. Okay, so when families start to think about inheritance tax as a structure rather than a single number, how does that change their understanding?
So I think if they understand the wider family picture and how it all interlinks, it can really change the way that you look at where the monies go and what taxes you're comfortable to pay now and in the future. So if, for example, you were looking at your own pension and we were in a position where drawing it would generate a 40% tax liability, and you're saying, I don't really want to pay 40% inheritance tax, if we viewed that picture a little bit further down and potentially the next generation were 40% taxpayers themselves, then you could draw that money from a pension and the children could put it back into a pension in their name. And if we're able to use the gifts from regular income and then a contribution into a younger generation's pension, we get that tax relief back. So from an income tax position, it's positive. From an inheritance tax position, it's positive. But it does require all parties to have those open discussions. And also looking at what their expenditure looks like. So if you do have surplus income, could you be passing that directly to grandchildren to pay for their school fees? Or if you were in a position where you'd got a trust set up, and most trusts tend to have some form of bond within it or something like that, could we allocate some of the segments to a younger generation, grandchildren, great-grandchildren, and encash some of those using their personal allowances, which could allow for the money to come out at 0 or 20% tax, where it may have been much higher charged if it was within someone else's estate? One of the other things that clients consider is, for example, the use of trusts. So if there is a trust structure in place that generally has an investment bond within it, what they will do is say, how can I ensure that this money is used in the best interest for my wider family? And many will assign segments of the bond to the younger generation, so grandchildren, for example. The monies are then encashed against the grandchildren, so using their personal allowance for income tax purposes. And then those monies can be used to pay school fees. That's very similar to using the gift from regular income rule that we talked about before, in that if there's surplus income there, that too could be used to pay for school fees and doesn't then carry tax consequences for any of the family from that side.
When thinking about how these allowances work together, what's the most important factor families often overlook?
That's the tough one because I think it falls back again to communication, unfortunately. Finances do tend to be a taboo. So rather than thinking about how do we make this work for all generations, each one perhaps looks at their position in isolation, and it doesn't allow them for all tax bands to be utilised across all individuals. But equally, if someone was aware that they were falling into the tax trap, for example, so their earnings were over £100,000, and they weren't considering that actually a very small pension contribution could get them their personal allowance back that they were making, and them not therefore pay, in excess of 60% tax on that element of money, would they think differently about whether they wanted to contribute to a pension at that time? Or if they were losing child benefit because they were over the limits for that, would they be comfortable doing something different if they knew it was going to get them those additional benefits back?
So get everyone into the will as soon as possible.
The will for assets that are within your estate for inheritance tax purposes, and an expression of wish if it's a pension. So currently it is an expression of wish that dictates where your pension assets go on death.
The 60% tax trap is a very hot topic and one that not a lot of people know about. Could you give us a little segment on that?
Absolutely. So where we stand at the moment is if your income is in excess of £100,000, then you lose your personal allowance by £1 for every £2 that you're over. I nearly said that the wrong way. So by £1 for every £2 that you're over. So by the time you've got, to £125,000, you've lost £12,500 of your personal allowance. If you had made the decision to make a pension contribution, which allowed your income then to be reduced below £100,000, then effectively you're saving around 63% of tax, which is what it works out at with losing the personal allowance and paying income tax.
So if you're in a period of paying a lot of money into your pension, that is a very savvy way of doing it.
Absolutely. And we do know that that's scheduled to change. It did come in the recent budget that they're looking at changing salary sacrifice, for example, on pensions. So it is going to be worth looking out for all of the backing papers coming out for that over the years to come, because it's not coming in until April 2029. But as we know, things change every year. We're constantly seeing changes coming in. We've got a lot of changes in April from the budget last year, which is going to see a change to agricultural relief and business relief. And then we've got the big pension changes in April 2027 as well. So lots to consider. And all of the different taxes, there isn't really a way of just discussing one. If you're looking at income tax, you tend to end up having conversations around how that would impact inheritance tax or capital gains tax. So they do all interlink. And it's important to make sure that whatever plans you've got in place are as adaptable as possible and making the most of any tax allowances. ISAs is another one, of course.
So the one thing that's very clear and obvious is that the tax landscape is constantly changing, and therefore having advice on an ongoing basis is a very sensible thing to do.
Yes, very much so. I think what I would say about today is, this is intended to give people a flavour for the sorts of things to consider and to talk to your advisor about. What this particular session today shouldn't be interpreted as is tax advice, because it isn't individual tax advice at this stage. This is about just saying, consider these things and have a look at how they'd impact you and your personal situation.
Absolutely. Thank you very much for saying that. And Michelle, thank you very much for your time. We very much appreciate it. It's been a very topical and interesting conversation. So thank you very much.
Thank you for your time.